Hello, friends. Welcome to the Weekend Investing Daily Bite of 7th of March, end of the week. And not a bad week, I would say. Beginning of March, we were still wondering if March can be a green month. And 1 week down, we are seeing the proof of that markets were oversold and markets are trying to make some sort of a comeback, although we may say that we're not yet out of the woods. Please do read the disclaimer and do subscribe to the channel if you haven't so far. Okay, now let's talk about the Nifty. Nifty closed at 22,552, 4 green days, something that we have not seen, I think, since probably October. I think I'm not able to see 4 consecutive green days on the chart since market started to fall. So that itself is a sign. May not be a conclusive sign yet, but the 2 day move above 22,300, 22,250 was certainly a sign that the market is trying to make a comeback. I, s- I suspect that we will at least go to 23,000 and then retest, the trend line there and then take it forward. So completely flat for the day, but no complaints on that for the day. Nifty Junior down 0.44%, but not yet able to even close this gap right here. So that shows you that there is some strength in the market with the bulls for now at least. Mid caps down quarter percent. So the last 2 days have just been consolidation, and small caps are also slightly up 0.69%, and small caps are up almost 1,000 points from the recent bottom. Actually, more than 1,000 points. So good comeback by small caps in the last 4 sessions. Bank Nifty extremely muted, minus 0.27%, neither here nor there, and that is fine for now. Gold is up 0.1%, again around 86,000. Gold is creating this flag like formation. And if there is some trigger news, I think gold can easily go up 3, 4, 5% in no time. When we look at market breadth is pretty much even today. So Nifty 500, you had about 264 stocks advance into 234 declines. Nifty mid cap almost midway, 44 to 56. Nifty 50 also 23 to 27. So reasonable day. The mid cap 150, the mid cap 50 actually had some more selling. The Nifty 200 also slightly on the bearish side, but no major biases on either side. The major contributor to Nifty today was Reliance. Reliance Industries up 3.32%. Um, Nestle up 1.5%. Uh, Bajaj Auto also 1.5%, and rest of the market you can see was more shades of red. So Infosys, HCL Tech, Levers, Titan, and TPC, IndusInd Bank all losing ground. In the Nifty Next 50 space, you had some big names losing ground. So Zomato, Indigo, Siemens Gas Authority, REC Lodha, Adani Green lost some ground. Bajaj Holding came back up 3.6%. IRFC, ATGL, DMart, HAL, these were some of the stocks that moved up. In the sectoral trends, you had defense move up 3% for the day. So 10.7% is the move on defense stocks in just 1 week. So defense has been the most beaten stock as well, sector, and that has made a comeback, still down 18% for the last 3 months. Media also coming back at 1.8% for the day, 7.4 for the week, still down 28% for the last 3 months. And rest of the market was pretty much uh, about plus or minus 0.5% from the mean. And public sector enterprise stocks, tourism stocks, IT stocks, and real estate stocks had some beating. Real estate stocks down 1.2% for the day, and they still are reeling at minus 24%. Another notable sector which is currently in the dumps is capital market, which is down 25% for the last 3 months. So these are some of the places where the real pain actually exists. Defense, as you can see, made a sort of a double bottom and has crossed this pivot, and hence the technical move is on the higher side. 2.96% here. Data patterns, Paras Defense, GRSE, Bharat Dynamics, Zentech, Mazagon, uh, Astra Microwave, Mishra Dhatu, all these stocks doing well. It may be that the government has asked LIC to support the market a bit. That may be a reason. Also, uh, when you get very oversold, I mean, short sellers also start to panic. It's not just that buyers panic all the time. Sellers also panic, and that usually also is a sign of complete oversold. So this Friday evening, we will be doing the Ask Weekend Investing round number 37. We've answered uh, triple six number of queries so far. We've done 36 rounds in the last many weeks, and prior to that, many years as well. Uh, you can go through all these videos; they're all available. Um, Sachin has the first question here, 667. Now that the market is recovering, so this statement itself is, not really true. Yes, it is recovering from this leg of sell, but we really can't say that, some bottom is made and market is going to recover. So bear that in mind. Should we truly feel relieved, or is there still an underlying fear that this rally won't last? That fear will remain. How do you differentiate between a real recovery and a bear market bounce? It's a good question, but uh, as you will see that tops and bottoms cannot be called while they are happening. You can try to predict; it may sometimes be right, but more often than not, these are hindsight uh, labeling. Okay, that was the top and that was the bottom 2 months back. So as you make higher highs, higher lows, once that pattern is made, you may say that that was the bottom, but then that would have been a month and a half back. Like when we topped out in September end, only probably by October end or November did we start to say that okay, that seems like a top uh, of the rally. So when you are inclined towards investing using uh, you know metrics which is not the top and bottom as your main sort of condition, if you're playing the market saying that I want to sell at the top and I want to buy at the bottom, it will never happen that way. It will never happen. You will never succeed with that, because sometimes once in a while, once in a blue moon, you will strike your prediction right, but to do that consistently is next to impossible. So don't my sense is that don't even have any emotion about bottoms or tops. As long as you are following your structured approach to the market, that's good enough. Whether it is momentum style, even if you're doing value style, you should be true to your style of investing. If you're finding value, buy value. If you're finding momentum, buy momentum. Why do we really need to worry about market tops and market bottom? That would be my answer. 668 question. Manu Sood says, once a rebalance comes, any insight if you should do it at 9:30 on Monday or try and time during the week? So a lot of people have tried different times, different days, different times during the day. I think if you just stick with one consistent time for yourself over a period of a year, you'll find it makes no difference versus anybody else, because the performance is also taking the open high low close average of that day. So sometimes you will get better pricing than what is that average. Sometimes you may get worse pricing than that average. Over a period of time, it will even out. So the idea is not to try and time this. Some people do it on the next day as a practice. Some people even do it on 2 days later. People have come and told me that we do it on Wednesday and it makes no difference. So sometimes there will be difference when there is crisis in the market, or when the market really makes a very large move upwards. But more often than not, these things will not matter over a span of a year or two. That's the sort of experience of a lot of folks. Harsh Nahata says, for rebalance, as I mentioned, weekly it is important to realign with stock and strategy, but in some cases, a stock added a week before was exited in the next rebalancing, booking losses. So this can happen, especially in choppy markets where stocks that were included last week uh, suddenly start to drop, and the strategy may, in the next rebalance, may decide that that's not the best stock to be with the next week. So there can be a chance that uh, you will get the stock out in a week, or there may be a chance that the stock will stay with you for 6 months or even a year and a half in many cases. So again, there could be also a chance where stock comes in, next week goes out, 3 weeks later it again comes in, 4 weeks later it again goes out, and you may hit a choppy phase for 2 3 times, and before the last time when you come in, it may become a multi-bagger. You never know. So when you are not in a discretionary mode of investing, you don't worry about this. Yes, it is painful, it is transaction cost, but that's what the entire system is built on. So we have to go as per what the rules of the game we are playing. As Ahuja says, markets recover, but portfolios recover at different speeds. How do you decide whether to stick with underperformers or rotate into strength during a rebound? So we have no discretionary decision that is going on in any of the strategies where I may feel that this stock should be doing better, hence I should stick with this, or this stock is not doing well and hence I should drop it. It is all based on the rules of the algorithms that we have, and over a period of time, they will the idea is to remove losers and to stick with winners. That is the simplest idea that I can share with you. And the stocks which will have continuous strength will automatically come into the strategies. Stocks that are continuously dropping will automatically get dropped at some point. So I mean, there is no question about any human sort of discretion in that decision making. Ashwin says, which one, according to you, is more dangerous for long term wealth building? FOMO in a rising market or panic in a falling market? I think both are dangerous. But if you want me to pick one, I think panicking in a falling market is probably a worse decision, because you don't want to be out of the market for those few days where markets are going to give you gigantic bounces. Like if you see the structure of the entire market over, let's say, 5 years, you will find that there are these 25 days within those 5 years which had the maximum impact positively on your uh, portfolio. So if usually why a panic bottom will happen is where everybody is feeling like giving up their shares. So that's usually when the bottoms happen in markets, and panicking at that time definitely is. And what happens after that is that once you exit at a panic in a bottom, and then let's say market next 3 days is up 10%, or your stocks are up 10%, you won't feel like buying them. You will want to wait for them to come down again, and then let's say a month later they are at 20% higher. Then the game is lost basically. So not exiting the market is, I think, a smarter move than maybe adding funds in FOMO. Maybe you add some more funds in on FOMO, but don't exit the market. That won't cause you as much damage, I think. uh, but that's probably my answer to this. Narendra says, how does one deal with the frustration of seeing the index go up while the strategy doesn't, or the strategy go down sharper than it? How to remain committed during such instances? It's a good question. It is all about expectation setting. In your mind, if you are expecting that your strategy has to beat the index on a day-to-day basis, you will be disappointed. Uh, because there will be times when the strategy will not beat the index even over a year, even over 2 years sometimes. And then there will be other periods where strategy will continuously beat the index for 5 years in continuation. So all those instances will come. Your confidence should be that the strategy in question is going to perform basis what the model is, in the sense that it will pick strength when the markets go up, it will ditch losers when the markets will go down. Yes, during by doing this there will be lag in terms of performance from time to time. For instance, uh, many of the absolute strategies are now sitting at 80 to 95% cash. Now, if the market has started to go up, let's say 3 days we have been up. What if this 3 days extends into 10 days up, and we've had an intermediate uptrend? All these strategies are likely not to have you know go from cash to stocks so easily. Only when some robust trends would have been made, those stocks will start to come in. So we will lose some initial portion of the rise when we go from the bottom. So you'll have to watch the index go up while the strategy is completely flat. But that's the design of the strategy. Once it is populated, once the trends are there, hopefully the stocks that we will pick will then start to outperform and catch up. And that at some point of time, that catch up will become outperformance. Sometimes it may not happen. So it is all about having confidence on the strategy, and having the expectation that over a long period of time it is likely that the strategy will be able to do its thing. But of course there cannot be any guarantees with anything actually. So having a realistic expectation probably is the best way to avoid any frustration. Manu Sood has another one. When we are in a downward momentum and book losses every week, a lot of capital gets wiped out. I have lost 20% in 1.5 months. Hence, a question comes to my mind like wealth builder portfolio. Why don't we keep some cash in capital compounder also? So, as I mentioned in the previous question, there are two styles of investing. One is a absolute momentum style where we can go to cash. Wealth builder, for instance, is in cash, big cash right now. Capital compounder is designed to not go to cash. It is designed to mimic the index and beat that index. Like, assume that you are an index investor. When you look at certain strategies which are designed not to go to cash, you are like an index investor and you're trying to beat that index by focusing on the strength of that index. So if you are, let's say, index investor in Nifty, for instance, so can you? I mean, you don't even expect, right, that Nifty is going down. So why don't we go to cash? I mean, that thought is not there in your mind because the design is such that you've invested in the index. So just like that, when you invest in rotational strategies, uh, consider that you are investing in those indices, those underlying indices, which are actively managed to try and beat those index. That is the only difference. If you are averse to, not going to cash, uh, then of course you should not be in rotational momentum strategies. But I think over a longer period of time, both have done well at different times. If you have both of these strategies of different designs, I think both of them combined will do very well for you. Shashwat says, I have both absolute and rotational strategies. I've noticed absolute gives more pain during recovery and rotational gives more pain during the fall. You are absolutely right. Is it possible to minimize this pain incurred by two different styles? So it is possible to design a strategy which will sort of combine the best of both worlds. Um and we will work on those kind of designs of strategies in the future. But having combination of these two baskets in your portfolio itself is a way of lowering the pain, having some asset allocation along with this. For instance, let's look at mi evergreen, which is cnx 200 plus gold. That has done fantastically well because while you are mimicking the index in a rotational strategy, you are still having a significant portion also allocated to a asset allocation. So that combination has really worked well. Similarly, when you will combine absolute and rotational, you will get that cross synergies and cross what you can say, uh, complementarity of some cash coming here while this one is bleeding, and while this goes up very rapidly rotational when upward movement happens, and this goes slow. So they basically are providing complement to each other on the upside as well as downside. That would be my sort of answer to this. Rohit says, as the name suggests, weekend investing, why not have weekend rebalance on all small cases? Even if there is no rebalance, at least a check on it. Okay, so Rohit, I'm not sure if I'm getting your question right. So most of the weekend investing strategies are weekly rebalanced. Just before the weekend, you can say we rebalance basis Friday close, and post the weekend is when the rebalance gets executed. So the name is justified in my view. Um, Yes, we have a couple of monthly rebalance strategies. Those came around later when we had to, address a lot of users who did not want weekly strategies. They said, we only want monthly strategies, so we designed some for them as well. So you can say it is fourth weekly strategies for them. If there is no rebalance, the platform sends a message. There's a notification on the Smallcase app that there is no change on the portfolio. So there is a check that happens all the time. There is no way that no check is happening at each week. Chetan sir says, what is the maximum market order one should put for Zerodha liquid ETF, as allocation to this is very high in some strategies and investing full strategy amount would largely mean a big market order for liquid ETFs? So this is a good question. Um, I would imagine that if you are sticking to the recommended portfolio size for the strategies, it should not make any impact. And don't create a liquid ETF market order in the first few minutes of the market. That is essential. If you like, and if your size of your portfolio is larger, do manually check where is the buy sell on the ETF. Most likely it will be a 1 paisa spread with several million lot size of buyers and several million lot size of sellers. If that is not the case, hold on to your rebalance. So it probably means a bit of a one step check, but that would only be for larger orders, so as to say. As long as if you're sticking to the recommended portfolio size, I doubt if this will make any difference, because most of the time I see that there are very big buyers and sellers for the liquid ETFs. Of course, try to avoid the first let's say 15 minutes of the market at least. uh, I In general I would recommend avoid the first 45 minutes for all rebalances, but a lot of folks want to do at 9:30, 9:45, so on and so forth. So I hope some I've been able to give some answer. Abhishek says, for checking momentum, would you give more weightage to recent months like 1 month performance, or let's say 3 or 6 months? So it depends upon the design of the strategy. It's like, you have a 800 cc engine, and how do you want to tune it? It could be a turbocharged engine, or you can tune it for better efficiency. It all depends upon the design of that particular strategy. So, I mean, we could, in some strategies, we may give more importance to recent months. In some other strategies, we may not have any importance to recent months. From which data provider do you get the historical index constituents? There are many data providers. There is, for instance, Global Data Feeds is there. Then VeraTech provider is there. Then several providers are there. I mean, there's a long list. If you just Google it, you'll be able to find it. Okay, so this is the end of this episode. Do send us more queries if you think we've missed your query. Do send us on email. You can put it in the comment section. I'll try to take it up there as well for the next episode. And also go through all the past episodes if you wish to, improve on the answers to many questions that the community has. There is a very strong weekend investing community. They also help each other. So if you will write comments on the YouTube, more often than not, before I can answer it, somebody else will answer it, and rightly. So make use of that common knowledge base that is already available there. And I wish you all the best. And do like and share these videos and subscribe to the channel if you haven't so far. Thank you so much. Bye bye.